Good morning. Welcome to Stock Market Today. It's Monday, October 21st, 2019, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics, back in the saddle. You can find me on Twitter at @DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today to sign up for an email that will give you daily stock ideas for you to consider upon further research every trading day before the market opens. So U.S. equities were down in Friday's trading, though the S&P 500 posted a gain for the week. REITs, utilities, and financials outperformed, while technology was the worst performing sector on the day. Treasuries were mostly stronger, with some curve steepening. The dollar was weaker versus the euro and the yen. Gold finished down 30 basis points. WTI crude settled off 30 basis points. So again, your outperformers, REITs, Utes, Fins, throw in the staples. Underperformers, tech, comm services, industrials, and energy. Now, as we get to the desk this morning to start the week, futures are up 30 basis points on a Monday morning. Treasuries are weaker after that bullish move last week. The dollar is firmer versus both the yen and the euro. Sterling not doing much amid the latest Brexit headline volatility. Gold is stronger, ever so slightly, and WTI crude is trading down by 40 basis points to get a new week going. And here's the S&P 500. I'm calling it knocking on the door at the resistance level. 3,000 has been this key line in the sand, right? We've tried to punch through it a couple times over the past few months, but haven't been able to do so in a sustainable way. And again, last week, a couple of shots on goal at the 3,000 mark, but the goalie is standing firm for the time being. Key support is at the 200-day moving average near 28.65, the upward sloping 200-day moving average, that is. And then the August lows near 28.20 is really the line in the sand where I say if that's broken in a confirmed manner, the structure of the market has likely changed. For now, the RSI is holding in bullish ranges above the 50 mark, but Chaikin money flow does remain on a bearish reading and is actually starting to dip down a little bit further into that bearish reading. So something we're going to watch closely here as earnings season continues. Going to start to hear from some bellwether names in the technology space this week. So continue to watch here. Right now, the market's still in a consolidation, knocking on the door of a breakout, but so far unable to push through. Continue to watch these key levels closely. Now, our market in a minute. What are we writing about? In the note today to Chaikin Analytics clients, well, S&P 500 trading near the highs of the recent consolidation range. Financials beginning to show signs of relative strength. You heard me talk about them a few times last week. Bank earnings starting to push the Fins into a little bit of a relative outperformer. We'll take a look at that. And that's happening just as the 10-year yield may be beginning to build a base above support at the 1.5% level. Dollar weakness could be a tailwind for commodities. Dollar trend really came under pressure last week. We'll take a look at that. And as I said earlier, futures do point to a higher open today. Power bars for the major indices, taking a look at those here now. On Friday, the Dow was down nearly 1%. Underperformance, largely a function of weakness in Boeing. Remember, the Dow is a price-weighted index. 4 bullish or very bullish stocks there. For 7 bearish or very bearish stocks. S&P 500 down 41 basis points, 106 bulls to 92 bears. NASDAQ was an underperformer on the day, 1916 bulls to bears. Small caps, inline performer. Still the most bullish of all the ratios out there, but cannot get much traction from a relative standpoint. 593 bulls, 366 bears. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain somewhat bullish, but the major markets across the board are mixed. Let's hit our stock of the day now, and this is one that I actually highlighted a week ago, Sunday, so previous to yesterday. I had the honor of writing our Market Insights notes for Mark Chaikin, and KCAC was my bullish stock of the week in that note. Got off to a little bit of a sluggish start. It was actually down nearly 2% last week, closed at 225.43, down 63 basis points on Friday, but it is a very bullish stock at Chaikin Analytics due to very attractive financial metrics, very strong earnings performance. Stock does have weak price volume activity, however, and the experts are middle of the road. But when we take the 20 factors, 5 in each of these 4 categories here, we come out with that very bullish rating. We have a strong trend, strong industry group. This is a solid uptrend, and this pullback here, I think, presents an opportunity on the long side of the portfolio. Let's take a look. We have a very bullish stock outperforming, oversold. Money flow is slightly mixed, but we're holding support, excuse me, at the rising long-term trend line. I think CACI in the IT services space is a compelling stock to look at here and now. Now, remember, 2 components to software and services. Software and services. We've been talking about software being weak, but the services component has still been strong, right? So CACI looks like an interesting name on the long side of the portfolio. Take a look at this one here. Very bullish stock outperforming the market. Our sector tracker now. Movement of the major sectors over the last 5 days. So roughly 1 week of trading. Healthcare at the top of the list, followed by real estate, financials, and discretionary. And real estate has actually been one of the more interesting groups to me as rates have stabilized and started to move higher. We've seen the financials do well, as you would expect. We've seen the utilities come under pressure, as you would expect. But real estate has held strong, continuing to outperform the market. We'll see if that can be sustained, but that's still a healthy trend, right? The trend in utilities is healthy as well. However, we're watching for early signs of a change there if rates are in fact stabilizing and beginning to move higher. Middle of the road, comms, materials, and industrials. Lower over the past 5 days, the staples, that's a little bit of defensive nature. Utes, we said tech and energy just resuming its spot at the bottom of the list. And the trend there remains horrible from both a technical perspective as well as the fundamentals if we look at them within Chaikin Analytics for the energy complex. And that's interesting because we have a weaker dollar, which we're going to look at later in the show, which should provide a tailwind to commodities. But we're not seeing it. We're not seeing it in oil. And it's not, and that in turn is not bleeding through to the energy complex. And just take a look. Look at the industry in focus today. The oil and gas equipment services group has underperformed the S&P 500 by over 39% over the past 6 months. And the power bar ratio, which measures future potential, is very weak. 23 bearish or very bearish stocks for 0, count them 0, bullish or very bullish stocks based on the Chaikin Analytics 20-factor model. That earns it a rank of 21 of the 21 subsectors that we look at. And the names in this group that you want to avoid or even potentially look for opportunities to take advantage of further weakness if you do trade to the bearish side: Helmrich and Payne, HP, very bearish rating; Drillquip, DRQ, very bearish rating; and Apergy Corp, APY, very bearish rating. And if we take a look at the fund that represents this group, you can see exactly what I'm talking about. And you could see why you should be resisting the urge to go bottom fishing for the time being, right? All signs point to continued underperformance. Why? We already talked about the ratio, 23 bears, 0 bulls. Very bearish Chaikin Power Gauge ETF rating for ticker symbol XES. The services ETF, weak trend below a declining long-term trend line, underperforming the market for more than 12 months to coincide with that very bearish ETF rating. The fund is now overbought within the context of a downtrend and has bearish Chaikin money flow. Still an area of the market that we think should be avoided or even look to be exploited with trades to the downside. Look at the options market. Look and see how the puts or put spreads are lining up within that space. Taking a look at what's trending now. Friday's S&P 500 gainers and losers, our movers and shakers. Kansas City Southern at the top of the list following their earnings announcement. ISRG, Intuitive Surgical, up nearly 7% following their report. STT, one of those financial stocks that we're going to look at a little bit later. Earnings sent that stock higher. They do catch an upgrade here today. E-Trade, right? A lot of drama around the online brokers in and around zero fee trading, right? $0 commissions. E-Trade put up earnings that were better than the street had expected, up 4.6% on the day. PBCT also up over 4% following their earnings announcement. Loser side of the board, L Brands, Downgrades, couple of downgrades, right? From Credit Suisse, L Brands down 9% on a downgrade. They downgraded the group, took Gap and Macy's lower as well. Boeing, some comments out of one of their pilots sent that stock lower, catches 2 downgrades here today. Recall on baby powder sends Johnson & Johnson lower by 6% on Friday. Netflix following through on their earnings report to the downside, right? Stock popped and then faded all day Thursday and then traded weekly all day on Friday, down 6%. DXC down 5%. As some of the services names were under pressure on Friday. Let's take a look at the charts now. What are we talking about in our note today? Well, it's big picture day. And one of the big picture themes that we look at on Mondays is interest rates, and we'll take a look at that chart next. However, what we're looking at here is the impact that stabilizing interest rates could be having on the financials, right? Because we are seeing some relative strength improvement. XLF, the Financial Select Sector SPDR fund, right, pretty much has gone nowhere for the past year. Slight upside bias as the fund is trading above a 50-day moving average and a 200-day moving average, right? But still very much in a consolidation similar to the S&P 500. And now, the financials have traded well on an absolute basis from the December 2018 lows, right? Nice rally here, right? From around the $22 level up to about $28.50, right? That's not inconsequential. The biggest problem that we've had with financials is the relative, right? Look at the bottom of the chart. That line is the XLF relative to the SPY, and that has been steadily declining, a solid downtrend as financials have underperformed the market. So if you were invested in financials, you haven't participated to the rally to the same degree as the S&P 500. But we're seeing some potential signs of momentum shifting on an absolute basis here as the financials no longer becoming oversold on pullbacks, and on a relative basis, we could be breaking this downtrend line here. We're starting to see some early signs of this downtrend line breaking. And what's interesting to me is that for the first time in a while, we've put in a higher low on a relative basis. It is still early days. It's early days potentially in the bottoming process for yields. But to the extent that yields are bottoming could provide a tailwind for the financials as the banks are putting up earnings reports that are receiving positive responses from investors, right? This is why we look at different asset classes to try to get a sense of potential shifts and what the impact could be to the equity market. And here's what we're looking at. Here's the 10-year yield as it continues to build a base around support at the 1.5 level, having recently traded above the 50-day moving average, which is now beginning to round higher. Still work to do, right? Not out of the woods just yet, still below a declining 200-day moving average. But what's interesting to me is this subtle shift in momentum, right? As rates were falling precipitously, the RSI routinely became oversold and never became overbought, right? Very rarely did it see readings above 60, really, but routinely fell below 30. But now as we're stabilizing, look at what's happened. We got one of our highest RSI readings in the past, well, really since last October, so in the past year, on this spike higher. And then this pullback did not produce an oversold reading, right? So a subtle shift in momentum. And that's why I've drawn these boxes like this, right? Bearish momentum, right? Down towards the lower end of the ranges. And now a subtle shift higher as we build a base. As I said, we're not out of the woods just yet. But if we are in fact building a base, and I read a report earlier today that said investors are positioned for further downside in yields, actually betting that yields in the US go negative. Well, that speaks to sentiment and positioning as far as I'm concerned, right? And the market could make a fool out of a great number of people by sending rates higher. Just something to keep in mind. Finally, dollar weakness could help commodities. Here's the UUP, the Invesco DB US dollar bullish index, right? And look at the pressure that it came under last week. Dropped right through the 50-day moving average, still above a rising 200-day moving average and above key support at, call it the 2640, 2650 level. But something to watch closely, because if momentum goes bearish and this trend changes, we would expect to see commodities, here's DBC, the commodity ETF, begin to rally, notwithstanding the weakness that we mentioned earlier in crude oil. So just something to keep in mind as the week gets started. That's going to wrap it up for today. Head over to ChaikinAnalytics.com/today to sign up for that email. I will see you back here tomorrow. Have a great Monday, everyone.